So today we're going to talk about a company called Time Technoplast, and really it's a tale of two companies in one. You've got this super solid, stable business, and then you've got this exciting, high-growth bet on the future. Let's dig into how they're making both work at the same time. Okay, let's just start with the headline number, shall we? A 20% jump in profit year on year. I mean, that's the kind of number that makes you sit up and pay attention, right? It tells you something is going really well. But honestly, that's not even the most surprising part of this story. Get this, for the first time in 35 years, they announced a bonus for shareholders, a one-for-one issue. So what does that mean? Well, it's basically the management saying we are so confident in our future that we are effectively doubling the number of shares out there. That's a massive statement of belief in where the company's headed. All right, so let's get into it. Section 1, a quarter of records. We're going to look at the financial story behind those big headlines. Okay, so here are the core numbers. And really, you can't argue with these. Sales are up 10%, profits are up even more, but here's the detail I want you to notice. Look at the volume growth. It's 14%. So they're selling 14% more stuff, but their revenue only went up 10%. Now, you might think that's bad, but it's actually a really good sign. It likely means their raw material cost went down, and they passed those savings on to their customers. That's what a healthy, high-volume business does. So, all that great performance we just saw, it's all built on a really solid base. Let's talk about that. Section 2, the stable foundation. These are the core businesses that act as the steady engine for the whole company. And man, is that foundation strong. Just look at these pillars. Their industrial packaging, they've already got orders for 425 crores locked in for next year. Their big bulk containers, the GNX brand, they're going toe-to-toe with major global competitors right here in India. And maybe most important, their high-margin, value-added products now make up over a quarter of everything they sell. This is the cash cow. This is what pays the bills and funds all the exciting stuff. Okay, this chart right here, this is everything. This is the whole story in one picture. On one side, you've got their core packaging business, growing at a nice, steady, respectable 10 to 12%. Great. But then you look to the other side, the composite products. We're talking 28 to 30% growth. That's not just growth, that's explosive. This is where the story gets really interesting. All right, Section 3, betting on the future. Let's find out where that explosive growth we just saw is actually coming from. So they have this really smart strategy. Think of it like a ladder. On the bottom rung, they started with what they knew, mastering LPG and CNG cylinders. Okay, check. Now they're on the next rung, doubling down and massively expanding their production. The next step up, that's developing advanced hydrogen cylinders, which is a huge deal for green energy. And at the very, very top of the ladder, that's where it gets wild. They're looking at things like drones. And look, this isn't just some PowerPoint fantasy. They are putting their money where their mouth is. A brand new plant in Gujarat is going to take their capacity for these critical cylinders from 30,000 a year to 66,000. That's more than double. That is how you get to that 30% growth we were talking about. And remember that top rung of the ladder, the drone stuff? Well, here it is. They've inked an exclusive 3-year deal with a drone tech company. The mission? To build super lightweight hydrogen cylinders for drones. Now, why is this a game changer? Simple. More hydrogen means longer flight times and higher altitudes. And when you're talking about a drone market in India that could hit 75 times billion dollars, yeah, this is way more than just a cool side project. This is a massive bet on the future. You know, growth like this doesn't just fall out of the sky. It has to be planned. So, Section 4, playing the long game. Let's look at the strategy that's making all this happen. And this is basically management's playbook. You can see they're thinking several moves ahead. First, they have this really tough target for profitability, 20% ROCE. We'll get to what that means in a sec. Second, they're chipping away at their debt every single quarter, no exceptions. Third, they're selling off stuff that isn't core to their business and plowing that cash back into growth. And finally, they're investing in green energy. It's a really smart, disciplined approach. So that term I just mentioned, ROC, what is it? It sounds complicated, but it's not. Return on capital employed. Just think of it like this. For every dollar the company invests in its business, how much profit does it get back? So a higher number is obviously better. And targeting 20%? That's ambitious. It shows they're not just chasing sales. They're focused on making profitable sales. Okay, so we've seen the solid foundation and the ambitious plans for the future. So what's next? Let's talk about the road ahead. Our last section, outlook, ambition, and a final question. You've got to hear this quote from the management team. They said that even without a QIP, which is just a fancy way of saying raising money from big investors, they plan to be debt-free in the next 18 months. Think about that. They're basically saying our main business is such a cash machine that we can pay off all our loans in a year and a half just from our own earnings. Wow, I mean, that is some serious confidence right there. So that's where we are. You've got this incredibly stable, profitable core business that's just churning out cash. And it's using that cash to fund these huge, exciting bets on the future, on things like hydrogen and drones. You've got a smart management team and massive demand. So the question we're left with is pretty simple. Can they pull it off? Can these big, bold bets on the future actually pay off?